A rare earth truce is active between the United States and China through November 2026. That headline alone has been enough to compress the risk premium in many rare earth equities. The consensus read is simple. Diplomatic progress means supply normalizes, so the emergency bid in explorers fades. That read is wrong, or at least it is incomplete in a way that matters for positioning. The truce is a diplomatic ceiling. It is not a physical one. China is still throttling actual shipments of rare earth materials despite the agreement. The truce constrains escalation. It does not compel delivery. Those are two entirely different market states, and conflating them is where the consensus mispricing lives. Here is the unstated premise the consensus takes as given. If a truce exists, China's enforcement compliance can be assumed. But China's historical track record on rare earth export controls, going back to the 2010 Japan incident, shows that export restriction is a tool Beijing deploys tactically, often below the threshold of formal treaty violation. Throttling is not the same as an embargo. It does not break the truce. It simply persists within it. The Carnegie Endowment analysis of the post-Trump Xi summit makes this architecture explicit. The U.S. listed specific critical minerals among its bilateral concerns. China agreed to address those concerns, a phrase both readouts treated differently. The U.S. fact sheet said China would address specific critical minerals concerns. China's readout said the two sides would jointly study and resolve them. Those are not the same commitment. The gap between address and jointly study is where the throttling continues. Treasury Secretary Dissent added another layer. The administration is not in a rush to extend the truce beyond November 2026. That is not a minor footnote. The truce expiry date is the horizon event every Canadian rare earth explorer is priced against. If the truce is extended, the supply risk premium compresses further. If it lapses, or if China interprets the USMCA review's China limiting clauses as an act of bad faith, the premium re-expands sharply. The terminal uncertainty is not resolved. It is deferred to November. For a holder of Canadian rare earth or critical minerals equities, the position question is this: are holdings in a deflating emergency trade or a structural optionality position on a supply chain that has not yet been rebuilt? Those two framings carry very different holding periods and very different invalidation conditions. The market is pricing the first. The physical throttling data supports the second. That is the gap this analysis investigates.
When the thesis is structural, the confirming signal is not price. It is capital allocation behavior. And this week, two discrete asset events reveal where sophisticated capital is repositioning inside the rare earth supply chain. The first is Greenland Mines securing the Sarfartoq neodymium-praseodymium project in a $35 million deal. Sarfartoq is an NdPr deposit, the magnet materials at the center of the EV motor and defense drone supply chain. The $35 million price tag on a single project acquisition in the current capital environment is not a speculative punt. It is a strategic land grab for a project with proximity to Western market access and zero China entanglement in the ownership structure. Greenland's geographic position matters here. It sits outside the China-influenced processing network that dominates Southeast Asian rare earth refining. The West's strategic failure has not been in finding rare earth deposits. It has been in building the processing infrastructure to compete with China's dominant refining capacity. A Greenland-based NdPr project with a Western ownership structure bypasses the Malaysian and Myanmar processing nodes that China effectively controls. That is the asset-level thesis the $35 million is buying. The second event is Mobix Labs announcing the acquisition of Special Project Delivery, a U.S. rare earth and critical minerals company. Mobix Labs is a semiconductor and connectivity company pivoting into the critical minerals supply chain. The acquisition signals that corporate consolidation in the RE space is accelerating outside China. When semiconductor companies begin acquiring mineral supply chain assets, that is not a financial trade. That is vertical integration driven by supply security anxiety. The demand arithmetic is not subtle. Critical mineral demand is projected to grow 500% by 2050. The U.S. Department of Defense has already committed $96 million to an Australian company operating in Malaysia to begin displacing China's 90% grip on EV and defense magnet supply chains. Canada has now committed over $65 billion in defense spending, its first time reaching 2% of GDP since the Cold War. The Saab Global Eye procurement alone is projected to support 3,000 Canadian aerospace and defense jobs. That defense industrial build-out creates a domestic critical minerals demand signal that did not exist at the same scale 12 months ago. Taken together, the Greenland Mines deal and the Mobix acquisition are not isolated events. They are two data points on the same capital allocation curve.
Sovereign governments and corporate buyers are paying for supply chain optionality now, before the November 2026 truce expiry creates a harder deadline. The residue for Canadian critical minerals equity holders is a relative value question. Australian and Greenland-based projects are attracting acquisition capital at visible price tags. Canadian-listed explorers with comparable deposit profiles are still priced at a discount to those transaction multiples. That gap is either a valuation inefficiency or a risk premium the market is charging for project execution uncertainty. Determining which, project risk or analytical gap, is the position reconsideration trigger.
There is a second dimension to this week's rare earth story that has received almost no attention in equity analysis. It is the demand side, and it is specific to Canada. Prime Minister Carney struck a landmark trade deal with China this week. The headline terms, up to 49,000 Chinese EVs into the Canadian market in exchange for lower canola and agriculture tariffs. The reaction focused on the automotive and agriculture dimensions, but buried inside that deal is a critical minerals dimension that the Carnegie Endowment analysis flagged explicitly. The U.S.-China Board of Trade has been tasked with addressing critical minerals restrictions, a stated U.S. priority. Canada's bilateral deal with China creates a parallel and potentially conflicting dynamic. Here is why this matters for Canadian critical mineral stocks. Canada is simultaneously pursuing a trade rapprochement with China, the country that controls the rare earth processing Chokepoint, and building a domestic defense industrial base that requires non-China rare earth inputs. Those two policy directions are not yet in conflict, but they are pulling in opposite directions. The Canada-China deal gives Ottawa leverage to negotiate lower rare earth export restrictions, specifically toward Canadian buyers. That would be a supply-side improvement for Canada's downstream EV and defense manufacturers. But it would also reduce the urgency premium that is keeping Canadian upstream rare earth explorers bid. The explorer's thesis depends on supply scarcity. A Canadian-specific carve-out in China's export throttle would compress that scarcity argument for Canadian buyers specifically. The U.S. Trade Representative has already signaled that Canada's China EV deal is problematic. If the U.S. interprets Canada's bilateral China engagement as inconsistent with North American supply chain alignment, a core USMCA review objective, Canada could face pressure to walk back the deal. That geopolitical triangle, Canada, China, US, is not resolved. It is the ambient uncertainty that the November truce expiry date will eventually force to a decision. For Canadian rare earth equity holders, the monitoring variable going into the second half of 2026 is not the Greenland Mines project timeline. It is the U.S. treatment of Canada's China engagement in the USMCA review. If Washington accepts Canada's bilateral China dealings as consistent with North American supply chain alignment, Canadian critical minerals companies gain access to both Chinese processing infrastructure and Western capital flows. If Washington treats it as a backdoor breach of supply chain discipline, the USMCA review becomes a forcing function that accelerates capital into Canadian upstream rare earth projects because processing independence from China becomes mandatory, not optional. Both scenarios are live, neither is priced with conviction. The $35 million Greenland Mines transaction and the November truce expiry together set the benchmark for how that question will eventually resolve. Watch the USMCA review's China origin provisions, specifically whether Canada receives a carve-out, as the verification event for this entire thesis. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.